Welcome to The Explainer. So, today we're taking a deep dive into the frankly fascinating world of top tier Indian dividend stocks. And not just any stocks, we're looking at ones trading right near their 52-week peaks. We're going to be digging into some incredible data from Screener.in, plus expert insights from an Anand Rathi report. Basically, just to separate the noise from the actual wealth building strategies. Let's get right into it, because if you've been watching the Indian stock market lately, you know there's a ton of buzz, and honestly a lot of confusion around dividend announcements. I mean, you see it all the time on social media, right? A company announces a dividend, and suddenly, boom, massive FOMO. Everyone rushes to buy shares because it feels like a loophole, like it's just paisa hi paisa, the ultimate free money scheme. But we really have to ask the critical question based on our source material today. Are upcoming dividends really just free money falling from the sky? Spoiler alert, the market is smart. There's a very specific mechanic at play here that every investor absolutely needs to understand before they go out chasing these payouts. But before we get to the really advanced data, let's just do a super quick refresher on the exact mechanics using the really clear definition from the Anand Rathi report. What exactly is an upcoming dividend? Well, in simple terms, a dividend is a portion of a company's profit that is shared directly with its shareholders as a cash distribution. This isn't some theoretical value tied up in your portfolio balance. No, this is real, tangible cash that gets credited straight to your linked bank account. And honestly, the best part, you don't have to sell a single share to receive this passive income. So let's look at how this practically works for you, the retail investor. If you own, say, 100 shares of a company, and that company announces a 5 rupee dividend per share, you're going to receive 500 rupees directly in your account. Simple enough, right? But to get this payout, you have to hold the stock before what's called the record date. That simple little timeline is exactly what triggers the massive market rush we always see right before a dividend payout.
Section 1. The reality check.
Because look, if it were that easy to just buy a stock the day before the record date, collect your free cash, and then sell the stock the next day, well, literally everyone would do it. But we need to dispel some major market myths here, because any seasoned trader will tell you there's no perfect jugaad to trick the stock market. The market always balances its books. According to the Anand Rathi report, when a dividend is actually paid, the stock price usually drops by the exact amount of the dividend on the ex-dividend date. This is called a price adjustment. So if a stock is trading at 500 rupees and the company announces a 10 rupee dividend, on the ex-dividend date, the stock price will likely open and adjust right down to near 490. I literally can't tell you how many novice investors panic when they wake up and see their stock drop like this in the morning. But here is the absolutely crucial takeaway. You did not lose money. You just received that 10 rupees in cash. It is simply a transfer of value. The wealth just moved from the company's balance sheet directly into your hands. Your overall portfolio value, counting the cash you're about to get, stays exactly the same. And once you really understand this mechanic, you stop chasing every single dividend announcement and you start looking for something much, much more powerful. Fundamentally strong businesses that are actually growing. Which brings us to Section 2, Top 5 High-Growth Dividend Stocks. We ran this really cool analysis based on Screener.in data, specifically looking for companies with a market cap over 50,000 crores, solid return on equity, low debt, and, this is the key part, trading within 20% of their 52-week highs. We're not looking for companies scraping the bottom of the barrel just to pay a high dividend. Just look at the dividend yield numbers for heavy hitters like GE Vernova, T&D, BSE, Hitachi Energy, Multi-Commodity Exchange, and the legendary MRF. These are premium stocks. But notice their dividend yields. We're talking 0.22%, 0.27%, even 0.02%. Now, you might be wondering, why on earth are we highlighting yields well under 1% when we're talking about dividend stocks? Well, there is a massive catch coming. Because these aren't just dividend payers. These are absolute profit-generating machines. Let's look at their actual business growth over the last 3 years. 489.65%. That is the staggering 3-year profit growth for GE Vernova T&D. When a company is nearly quintupling its profits in just 3 years, that explosive business growth matters way, way more than a high initial dividend yield. Because as those profits compound over time, the absolute cash value of that dividend, it's going to grow significantly for long-term holders. And this growth isn't just limited to infrastructure. The Bombay Stock Exchange itself is riding the wave of massive retail participation in the Indian markets right now, posting a remarkable 124.14% profit growth over the last 3 years. They are sitting right near their 52-week high. A modest dividend yield today honestly means nothing when the underlying business is literally more than doubling its profitability. Then we have Hitachi Energy. Remember that premium stock price of over 33,000 rupees? Well, that valuation is fully backed by some serious fundamental momentum. They've achieved 121.78% profit growth over 3 years. And you know, when a company is expanding this rapidly, you actually want them reinvesting those profits back into the business rather than just paying it all out to you immediately. It's a sign of strength.
You don't get to trade within 20% of your 52-week high by accident. The Multi-Commodity Exchange absolutely proves this, doubling its profits by 107.53% in just a 3-year span. This brilliantly illustrates the true power of a strong underlying business model. The market simply rewards consistent, triple-digit profit momentum.
And finally, we round out this heavyweight list with MRF. Yes, the stock that trades at over 1.3 lakhs per share. Even at that massive scale and maturity, MRF is still pumping out 52.36% profit growth over the last 3 years, with incredible consistency, like an absolute boss. The dividend yield might look small on paper, sure, but the capital appreciation and the sheer business strength here are completely undeniable.
Section 3. The Pre-Buy Checklist.
Now, it's super easy to get excited by those massive growth numbers, but listen, you can't just blindly YOLO your money into a stock purely because a dividend was announced or just because it's hitting 52-week highs. You need a system. So here is your essential 4-point checklist directly from the experts at Anand Rathi. First, check the profit growth, exactly like we just did with the screener data. Are they actually making more money? Second, check their past dividend consistency. Do they have a proven track record, or is this just a one-off gimmick? Third, and this is absolutely critical, check their debt levels. Some companies will literally borrow money to pay dividends just to keep investors happy, which is incredibly dangerous. You want companies paying from strong internal cash flows. And fourth, check the business future. Is the industry itself actually growing? I really want to highlight this direct quote from the Anand Rathi report because it perfectly summarizes everything we've been talking about today. Experienced investors focus more on business strength than short-term dividend price moves. Strong companies with growing dividends and rock-solid fundamentals are usually going to perform well in the long run, and that completely eclipses those short-term price adjustments that happen on the ex-dividend date. Which leaves us with this final, crucial question to ask yourself before you make your next trade. Are you chasing a quick small dividend payout just for the short-term thrill of it, or are you truly analyzing the fundamentals to invest for long-term, multi-bagger growth? Because the data from Screener.in clearly shows us that the biggest winners out there aren't the ones with the highest yields, but the ones with the most explosive profit engines. Thank you so much for joining me on this explainer. Keep this checklist handy, always do your own research, and I'll see you in the next one.